I was just in a consulting session with a professional client a few days ago, and we went through the exercise of making an exact calculation to figure out why the 50 delta option of a leaps call was at a much higher strike price than what is actually at the money. It's because of the interest rate that works its way into the model. It also affects early exercise decisions. When market makers own high delta puts, like 100 delta puts and shares of stock, well, they're paying interest on the cost of capital of owning that stock and owning the put. And so they have to take that into account as well.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 78, The Metrics I Use on Wheel Trades and How They Work, Part 2. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. First, make sure you're subscribed to the show in your favorite podcast app. And if you're already subscribed to the show, you can go even deeper and get more with a paid subscription. With your paid subscription, you get video extra podcast episodes, so you can get hands-on video training on things we talk about on the show, subscriber-only posts where I drill down on a stock, event, or trading opportunity and share trade ideas. You'll get all my covered call and cash-secured put trades that I'm making in my real brokerage account. You'll get access to our monthly online Ask Me Anything webinar. You'll get our unusual options activity alerts on options income trades and much more. And the best part is your paid subscription helps keep this show on the air. You know what I do for a living? I figure stuff out. That's it. That's my job now. And actually, that's always been my job. When I was trading in the capacity of a professional trader, that's what I had to do every day. Now, as a professional options mentor, well, that's still what I do. How do I communicate this concept most effectively? How do I vibe code this thing and get it working? I'm figuring out lots of stuff every day. And as I think about it, that's really what it's like for anyone you call a professional, right? Doctors and lawyers, they call their business their practice. They practice medicine. They practice law. And I guess it makes sense. I feel like I share some commonalities with those professions. One thing I always say when working with student traders or professional consulting clients is that my first objective is to do no harm. You know, like the Hippocratic Oath. If someone's making money, but I see a flaw in their logic, they're not doing something right or overlooking something, I'll analyze the flaw, I'll point it out to them, but I'll encourage them not to just immediately stop doing what's working, but instead to dig deeper, to analyze why it's working. Could there be something that overcomes the thing that they're doing illogically? Could it actually be logical? Could it be just luck that's led to profits? Either way, for me, do no harm. And in sticking with the do no harm mantra, there's always compliance issues involved with communicating any financial information. You'll hear at the end of our show, our very deep voice announcer read the disclosure each week. Some of the clarifications of what I'm communicating are stuff that lawyers require. But I actually think it's all actually really important. I want to be very clear of what I'm saying and what I'm not saying. Words are important. I choose them carefully, or at least I try to. I consciously choose exactly how I phrase things. And that's something we're going to kick off this week's show with, something I like to go out of my way to be very, very clear about when talking about wheel trades, the concept of cost basis. Let's start out talking about this idea of cost basis or the break even of a trade. So, very notably, as a reminder, the cost basis that I'm talking about when I'm talking about covered calls or cash secured puts is not the same as the cost basis used for taxes. What the IRS or your accountant cares about is a different use of those same two words paired together. So the cost basis I'm talking about is intended only to help track how much the investment was benefited by the option. All right. For covered calls, the break even is the price of the stock at the time the call was sold minus the call's time value. For a cash secured put, it's the strike price minus the put premium that was credited. Each of these two are optimally used as one input into what we call the cumulative discount effect. Now, before we get into the cumulative discount effect, because it's related, we need to talk a little more about the break even. So we call it the break even, right? And so the idea is this, like if I just buy a stock, right? Well, whatever price I pay, if the stock is above the stock, I made money. And if it's below the stock, I lose money. My break even is just what I pay for the stock. Now, if I do something like buy a call, my break even, well, at any given point in time changes, but we're very commonly used to looking at what we call at expiration P&L diagrams. So like if I hold this call until expiration, the stock has to, in that case, rise above the strike price by the amount of the call premium in order for the position to break even, to make money. So with covered calls and with cash secured puts, it's the same concept, but here what we do is we end up lowering the cost basis, what we think about as the cost basis, which really I think that a better way to say it is the break even instead of the cost basis. That'll make sure that we don't have any confusion between the tax cost basis. Every time we collect an option premium, that lowers where our break even is on the trade. And that brings us to our cumulative discount effect. The cumulative discount effect, it solves a lot of problems than just looking at this very boring old textbook idea of here's the stock, I own the stock, I sell a call. Okay, so if I get that premium, then basically the stock can fall by the amount of that premium and I still break even. But that's a little bit of a fallacy, right? I mean, it's true in and of itself, but that's not how we trade covered calls or cash secured puts for that matter. As we know, the only way this whole wheel thing works is if we do it in cycles. Owning the stock and selling one call and then calculating your break even, your cost basis off that, well, what does that even matter? Because when that call expires, you're going to sell another call. Or if you get assigned, you're going to sell a put. So to really understand this cumulative discount effect, we have to take into account all the credits we receive. The cumulative discount effect for covered calls is the price the stock was originally purchased minus all the option credits from premium received minus all the option debits paid from closing the position and minus or plus all stock scalps that resulted from assignment. If they're negative scalps, meaning you lost money by selling the shares on a covered call assignment, but then buying them back on a cash secured put assignment at a higher value, well, then, that's a negative number. So effectively raising the break even in that case for that cog of the wheel. It makes the break even higher or worse for that that individual component of the longer term equation. The cumulative discount effect can be hard to measure without the right tools. Once the option expires, here's the problem. And here's the problem with brokerage firms. They make it almost impossible to measure how well you're doing on a covered call or cash secured put. We need a better tool. And I created one of those better tools, and I'm going to be telling you more about it in an upcoming episode that makes it super easy to track the results of covered calls and cash secured puts in the long run. It's something that's frustrated me for so long about just looking at my brokerage account like, oh, okay, here's where I have the stock. Here's where I sold the call. Fidelity, where I do trade a lot of my IRA stuff, they do a reasonably good job, as good a job as realistically they can in tracking this stuff. Because when they give you the cost basis of the shares you own, if you got them from a cash secured put, they will actually subtract that value from the strike price to give you a more accurate cost basis for it. But then once you sell a call on and that expires, like that doesn't get factored in. So anyway, a little bit more about that in an upcoming episode, because I think it's really important. It used to just drive me crazy. And so it was one of these things that I created just by necessity. Anyway, the next thing that brings us to, the most logical next thing to talk about, is the stock price basis. And this is pretty important to talk about. If you haven't noticed already, you may have noticed from stuff we talked about in last week's show and stuff we've talked about in previous shows, there are 3 different possible stock prices to use as the basis in all the equations that we're talking about here when we talk about the metrics that I use on wheel trades and how they work. There's the stock price at the time of the option trade. There's the stock price when it was originally purchased. And then there's the strike price. And depending on the equation, we use a different one of those, which seems kind of weird and seems kind of confusing, but it's the only way that it works. Static return, annualized yield, and break even all look at the stock price at the time of the option trade. We're talking covered calls here. That's really important. And in some ways, it's kind of a strange, arbitrary figure. At the time that the option trade is made, well, I mean, I bought the stock at a different price. What if I made the option trade 15 seconds later or earlier, whatever? That would result in a completely different numerical outcome. But that's the best way to get the best metric that helps us the most, to give us the most valuable information. So for static return and annualized yield and break even, that math is the optimal way to consider whether it makes sense to make the trade. Cumulative discount effect, which is also referred as the tracked cost discount, I'll say that sometimes, that uses the price that the stock was purchased, not the stock price at the time the option was sold. That's how to get the best use out of that metric. It wouldn't make sense to use that snapshot in time that we use for static return of where the stock was trading at the time the option trade was made if we're looking at the cumulative discount effect, because we've got to base it off the price that we actually bought the stock. The objective of the cumulative discount effect is to understand the long-term benefits of using options on the underlying as an investment strategy, as a broader investment strategy. Comparing the price of the stock where we purchased it minus the option premiums and plus the credits and taking into account the scalps, that becomes very, very valuable in monitoring long-term results. And it's the only way we get good at the wheel. Otherwise, we're just flying blind, looking at every wheel cog as one trade, and that's not a reasonable or fair way to do it. And then I mentioned also that sometimes we use the strike price, which we use when we're talking about selling puts. The skate return on cash, the skate yield. We have to use the strike price there because we don't own the stock. That's really important. The strike price determines the cash that is held in margin. That literally is what you should think of as the investment. This is the money that is mine, but my broker is putting it aside and it's still mine. It's still in my account, but I can't touch it. So the best way to think about it is that is my investment. It's like I'm paying for the stock at that strike price. But then if we get assigned, then it's going to be that strike price minus the put premium that we received. And if we don't get assigned, then it's going to be that put premium we received divided by that strike price. So, yeah, I mean, as far as what you would call the stock price basis, we've got three different ways of looking at it, but they each give us a more clear picture. So I thought that it would be worth just sort of throwing out there. The next thing is the interest rate and cash. We'll just sort of lump those together as far as metrics that I use that are important. The interest rate is a really important datum when analyzing wheel trades. From a modeling standpoint, the interest rate works its way into the disparity between call and put premiums, right? That goes into our put call parity formula, right? Even if we don't always think about it and we don't actually do the formula, we know, or at least we should know, that interest makes the puts cheaper and therefore impacts their theta too. When we're looking at an option chain and we look at the call theta versus the put theta for options of the same strike, I mean, they can be different. And that is because of the interest rate. When we're looking at it exactly at the money call and put, well, you would think from just theory that the call and put prices might theoretically be the same, but they're not. And that is because of the interest rate too. I was just in a consulting session with a professional client a few days ago, and we went through the exercise of making an exact calculation to figure out why the 50 delta option of a leaps call was at a much higher strike price than what is actually at the money. It's because of the interest rate that works its way into the model. It also affects early exercise decisions. When market makers own high delta puts, like 100 delta puts and shares of stock, well, they're paying interest on the cost of capital of owning that stock and owning the put. And so they have to take that into account as well. They have to say, well, here's a position that's basically zero delta. I mean, nothing happens unless the stock blows through that strike price. It's very likely to just end up getting assigned. It provides me no value, but I'm paying interest and I'm tying up all that capital. I should exercise the put early. And relatedly, when selling cash secured puts, when we set aside that cash, or I should say, when our broker sets aside that cash in the margin account to secure that the cash is there for assignment, again, that's why we call it cash secured put, right? That cash earns interest. And that affects the math of us making the decision to sell the cash secured put. I mean, boy, like if the market goes up 10% a year on average and we can make 4 or 5% interest on the cash that sits there, I mean, is it not horrible consolation prize for trades that don't work out? And that goes on top of what we're making on selling the put and doing that calculation. But of course, if I own the stock as part of a covered call, that means that the cash is not there earning interest. So it is theoretically an opportunity cost. It is a cost to me instead of a benefit to me. But the interest rate is also a benchmark, right? Cash is a position. It's owning US dollars as opposed to owning something else. It sits in a money market account or is converted to a treasury instrument, and we earn interest on that. So really, if you want to technically think about it, I guess you don't have a position in US dollars because you trade those in for either a money market account or a treasury instrument. So really, it's just pure interest. The interest that can be earned on cash sometimes might be the best investment an investor can identify. If you're in a bear market or some sort of other kind of dicey market scenario, cash could be king. In less extreme situations, the interest rate is still an important benchmark when considering trades for the dividend yield. We compare the target dividend yield with the interest rate, plus a risk factor for owning the shares of stock instead of a treasury instrument, which theoretically has no risk. We call it the risk-free rate. True or not, we do. So these are really important metrics as well. And last week, I just didn't think I'd have time to cram them all in. So these I put in here today, and boy, there's probably more than these. I don't know. This is really all I can think of at this point in time. And hey, like I said last week, I'm going through the book and going through chapter 19. These are the metrics that I put in chapter 19 to talk about in a similar fashion to how we talked about it on today's show. And that about wraps it up for this show. Before you go, hey, please do me a favor. Do yourself a favor. Make sure you're actually subscribed to this show so that you never missed the latest and greatest episode. Also, leave a comment. When you leave a comment, that helps me know what you like about the show, what you'd like to see different. Hopefully, you like the show because I love positive comments and I would really like to hear one from you. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read Characteristics and Risks of Standardized Options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.